It's time for the personal finance corner. Faye is here. Faye, what's up for discussion today?
Well, Aisha, in times like this, we normally start focusing on the defensive sectors. Now, I want to take a look at the FMCG sector. The FMCG funds that we have given 25% returns in the last year, which if you look at the market we've had, is quite impressive. Now, I want to bring in Dhirendra Kumar. He's the CEO of Value Research and he helps us with our mutual fund investments. Dhirendra, if we compare those returns on those FMCG funds, 25% in the last 1 year, compared to the Nifty that's only given us only 9%, I beg your pardon, year to date. We have two funds to choose from. There's the SBI FMCG and ICICI Prudential FMCG, and these funds tend to focus on India's consumption theme. As investors, would you recommend we add them to our portfolios to perhaps balance out our portfolios a little bit?
I would say that, FMCG funds have been blockbuster over the past 4 or 5 years. Ever since the market struggle started, these FMCG funds have been struggling, have been roaring. They have been the best performing sector funds. As I keep saying all the time, that sector fund is not a great vehicle for you to diversify. And if you hold any other investments, if you hold an equity fund, it will have reasonable exposure to FMCG. So if you happen to if you have an equity portfolio and you are very low on FMCG, this could be good vehicle. These could be good vehicle for targeted diversification that you want to supplement your portfolio with your FMCG exposure. Otherwise, I think if you are well diversified in generic equity fund, they will be 15-20% into FMCG. You can do without such funds.
Well, Dhirendra, there are only two funds. There's the SBI and the ICICI Prudential FMCG funds. Now, between those two options, which one do you think is stronger and which one should we invest in?
I would say that, both funds look impressive, but if you're looking for an opportunistic bet, if you just want to ride it, I would say SBI FMCG looks reasonably impressive.
All right, SBI FMCG fund there, Dhirendra's recommendation for today. We have a question that's come in from Sundar. He tells us he invested about 1.15 crore rupees in bank deposits. He wants to know how he should diversify that money to get more returns with no risk. Dhirendra, a lot of questions come in from conservative investors. They want the higher returns. They don't want the risk that comes with it. What would you advise someone like him to do?
For a conservative investor who has invested 1.15 crore in bank deposit, the good news is that you will get the safe return. The bad news is that you will not be able to beat inflation. 5 years from now, your 1.15 crore will not be enough. So there are 2-3 ways of approaching this. One is assuming little risk, which means you should have a small part, maybe 5% or 10% of your money invested into a well-diversified equity fund. If you have no appetite for that, then optimizing return on this investment, consider investing 25% of your money into dynamic bond fund, only if your money is for, you are unlikely to need your money for next 3-4 years. It will not be risk-free, but it will not be assuming great risk either. So you will be able to optimize your return by a percentage or so on the overall portfolio.
All right, a small allocation of equity there to beat inflation in the long term. Dhirendra, thank you so much for joining us and answering our questions. If you have questions for Dhirendra, write to us. Email ID is on your screen right now.